Picture this. You're building a Roth IRA that grows tax-free for decades, turning a few $1,000s into $1 million nest egg without the IRS taking a cut. That's the magic of a Roth IRA, a tax-shielded powerhouse where dividends and capital gains compound untouched. In this 30-minute video, I'm sharing 6 ETFs. Vanguard S&P 500 ETF, VOO, Invesco NASDAQ 100 ETF, QQQM, Charles Schwab US Large Cap Growth ETF, SCHG, Invesco S&P 500 Momentum ETF, SPMO, Fidelity High Dividend ETF, FDVV, and NEOS NASDAQ 100 High Income ETF, QQQI, perfect for long-term Roth IRA investing. A financial enthusiast picked these for their blend of growth, dividends, and low fees, delivering 15 to 21% annual returns. I'll break down why Roth IRAs are a must, how these ETFs supercharge your wealth, and tips to maximize tax-free growth for 2026 and beyond. Let's dive into building your financial future. A Roth IRA is your secret weapon for tax-free wealth. You contribute after-tax dollars, up to $7,000 annually if you're under 50, $8,000 if 50 or older, per 2025 IRS rules. Contributions can be withdrawn anytime, penalty-free. Earnings, like growth or dividends, are tax-free if you're 59 and a half or older and the account's been open 5 years. Break those rules, and you might owe income tax plus a 10% penalty on earnings. For example, invest $7,000 yearly at 10% for 40 years, and you get $1.2 million tax-free in a Roth IRA versus $800,000 in a taxable account after 20% capital gains tax. In 2026, with 5% inflation projected by Bloomberg, a Roth IRA's tax shield keeps more of your money working. These 6 ETFs, VOO, QQQM, SCHG, SPMO, FDVV, and QQQI, are built to maximize that advantage. First up, Vanguard S&P 500 ETF, ticker VOO, with an honorable mention to Vanguard Total Stock Market ETF, ticker VTI. VOO tracks the S&P 500, holding 500 of the largest U.S. companies, giving you broad exposure to the U.S. economy. VTI goes wider, covering over 4,000 stocks including small and mid-caps. VOO's diversification across technology, 30%, financials, 13%, consumer discretionary, 10%, communication services, 9%, and healthcare, 12%, offers stability. You're investing in giants like Nvidia, Apple, Microsoft, Amazon, and Meta. Its dividend yield is 1.3%, paying $130 on $10,000 quarterly, with a rock-bottom expense ratio of 0.03%, $30 per $100,000. VOO delivered 16% annual returns over 5 years and 15% over 10 years per Vanguard. In 2025, it gained 7.85% per Bloomberg. With 15% volatility, it's a smooth ride. A $10,000 investment grew to $21,600 in 5 years, versus $19,600 for VTI. For 2026, JP Morgan projects 8 to 10% S&P 500 growth, suggesting VOO could hit 10 to 12% returns, though a 10% correction risks a 5% drop. VOO's low fees and stability make it a Roth IRA cornerstone, with VTI as a broader alternative for extra diversification. Next, Invesco NASDAQ 100 ETF, ticker QQQM, with an honorable mention to Vanguard Information Technology ETF, ticker VGT. QQQM tracks the NASDAQ 100, a tech-heavy index of 100 non-financial companies, and it's the lower-cost cousin of QQQ, with a 0.15% expense ratio versus QQQ's 0.20%. VGT focuses purely on tech, including financial tech. QQQM's portfolio leans heavily on technology, 50%, with communication services, 15%, consumer discretionary, 12%, and smaller stakes in consumer defensive and healthcare. Top holdings include Nvidia, Microsoft, Apple, Broadcom, Meta, and Tesla. It yields 0.7% or $70 on $10,000 quarterly, with a $15 expense per $100,000. QQQM posted 17% 5-year returns and 20% over 10 years, gaining 18% in 2025, beating VOO's 7.85%. Its 20% volatility reflects tech's ups and downs. It dropped 12% in April 2025's 20% market dip, but recovered 15% by September. A $10,000 investment grew to $24,900 in 5 years, versus $21,600 for VOO. For 2026, Morgan Stanley's 10 to 15% NASDAQ growth forecast suggests 15 to 20% returns, with a 10% correction risking an 8% drop. QQQM's low fees and tech exposure make it a Roth IRA star, outperforming VGT's 16% 5-year return. Third, Charles Schwab U.S. Large Cap Growth ETF, ticker SCHG, with an honorable mention to Vanguard Growth ETF, ticker VUG. SCHG targets 200 large-cap U.S. growth stocks with high revenue and earnings growth, like Nvidia, Apple, Broadcom, Microsoft, Amazon, and Meta. VUG mirrors this with 208 holdings. SCHG spreads across technology, 45%, communication services, 15%, consumer discretionary, 12%, healthcare, 10%, and financials, 8%. Its dividend yield is 0.36%, or $36 on $10,000 quarterly, with a 0.04% expense ratio, $40 per $100,000. SCHG delivered 15% 5-year returns and 17% over 10 years, gaining 18% in 2025. So, wasansay received in mind incrediro are down for stores that are signed webstan and the sound the daughters smutlagrad in the $21,600 in 5 years, slightly trailing QQM about say 9 months, but beating Vocame with 18% volatility. It fell 10% in April 2025, but recovered 13% by September. For 2026, 10 to 15% tech growth projects, 15 to 18% returns, with a 10% correction risking a 6% drop. SCHG's low cost and growth focus make it ideal for Roth IRAs, with VUG as a comparable alternative. Fourth, Invesco S&P 500 Momentum ETF, ticker SPMO, with an honorable mention to State Street's SPDR S&P Technology ETF, ticker XNTK. SPMO tracks the S&P 500 Momentum Index, selecting 100 high-momentum stocks from the S&P 500, like Broadcom, Nvidia, Meta, JP Morgan Chase, Netflix, and Palantir. XNTK focuses on tech momentum. SPMO's sectors include technology, 40%, financials, 15%, consumer discretionary, 12%, communication services, 10%, and industrials, 8%. It yields 0.64%, or $64 on $10,000 quarterly, with a 0.13% expense ratio, $130 per $100,000. SPMO's 21% 5-year returns and 19% in 2025 crushed VOO's 16% and 7.85% per Invesco. A $10,000 investment grew to $26,600 in 5 years. Its 18% volatility matches SCHG, with a 10% drop in April 2025 and a 14% recovery. For 2026, 8 to 10% S&P 500 growth suggests 15 to 18% returns, with a 10% correction risking a 7% drop. SPMO's momentum edge makes it a Roth IRA growth driver, with XNTK as a tech-focused alternative. Fifth, Fidelity High Dividend ETF, ticker FDVV, with an honorable mention to Charles Schwab U.S. Dividend Equity ETF, ticker SCHD. FDVV invests in over 100 large and mid-cap dividend-paying companies expected to sustain or grow dividends, like Nvidia, Microsoft, Apple, Broadcom, JP Morgan Chase, and Visa. SCHD focuses on stable dividends with less tech exposure. FDVV's sectors include technology, 25%, financials, 18%, and healthcare, 15%, balancing growth and income. It yields 3% or $300 on $10,000 quarterly, with a 0.15% expense ratio, $150 per $100,000. FDVV's 15% 5-year returns beat SCHD's 12%, driven by tech exposure, gaining 10% in 2025, per Fidelity. A $10,000 investment grew to $20,100 in 5 years, versus $18,000 for SCHD. With 12% volatility, FDVV fell 8% in April 2025, but recovered 10%. For 2026, 3.5% dividend growth per Morningstar, and 8% market growth project 12 to 15% returns, with a 10% correction risking a 5% drop. FDVV's growth plus income mix is perfect for Roth IRA tax-free dividends. 6th, NEOS NASDAQ 100 High Income ETF, ticker QQQI, with an honorable mention to NEOS S&P 500 High Income ETF, ticker SPYI. QQQI tracks the NASDAQ 100, selling covered calls on its 100 holdings to generate high monthly income, unlike QQM's pure growth. SPYI applies the same strategy to the S&P 500. QQQI's sectors mirror QQQM: technology, 50%, communication services, 15%, consumer discretionary, 12%, with top holdings like Nvidia, Microsoft, and Apple. It yields 14%, or $1,400 on $10,000 monthly, with a 0.68% expense ratio, $680 per $100,000. QQI's 15% 2025 return, including dividends, beat VOO's 7.85% per NEOS, despite capping upside in a 15% NASDAQ rally. A $10,000 investment grew to $11,500 in 1 year. With 20% volatility, it fell 10% in April 2025 but offset losses with $120 monthly dividends on $10,000. For 2026, 10 to 15% NASDAQ growth and high implied volatility, 25% per CBOE, project 15 to 18% total returns, with a 10% correction risking a 7% drop. QQQI's income makes it a Roth IRA gem, with SPYI as a broader market alternative. Comparing these ETFs, VOO offers 15% returns, 1.3% yield, 0.03% expense ratio, and 15% volatility, safe and steady. QQQM delivers 20% returns, 0.7% yield, 0.15% expense ratio, and 20% volatility, tech-driven growth. SCHG gives 17% returns, 0.36% yield, 0.04% expense ratio, and 18% volatility, balanced growth. SPMO boasts 21% returns, 0.64% yield, 0.13% expense ratio, and 18% volatility, momentum-focused. FDVV provides 15% returns, 3% yield, 0.15% expense ratio, and 12% volatility, growth plus income. QQQI yields 14%, 15% returns, 0.68% expense ratio, and 20% volatility, income with growth. For 2026, Yidnao Sin Pindi Points Sripandi Endadejam Samayan SPMO and QQQM could hit 18 to 20%, while FDVV and QQQI deliver $1,400 to $3,000 on $100,000. Build a Roth IRA portfolio for 2026, 40 to 60% VOO, $4,000 to $6,000 on $10,000, for 12% growth, $480 to $720, 15% volatility, 20 to 30% QQQM or SCHG, $2,000 to $3,000, for 15 to 20% growth, $300 to $600, 10 to 15% SPMO, $1,000 to $1,500, for 18% growth, $180 to $270. 10% FDVV, $1,000, for 3% yield, $30, and 12% growth. 5 to 10% QQQI, $500 to $1,000, for 14% yield, $70 to $140. So we're puti. This yields $760 to $1,660 annually with 16 to 18% volatility, targeting 12 to 15% returns in 2026's 8 to 10% market per JP Morgan. Risks for 2026. VOO and FDVV risk 5% losses in a 10% correction, per Goldman Sachs, with quick recoveries. QQQM, SCHG, and SPMO risk 7 to 8% drops due to tech exposure. QQQI's covered calls limit upside in a 15% rally but cushion 10% corrections with $140 monthly dividends on $10,000. SMH's 25% volatility, from a related video, risks 15% losses but isn't here due to concentration. High expense ratios, QQQI's 0.68%, erode returns, $680 on $100,000 yearly. Diversify to mitigate risks, with VOO as the anchor. 3 non-financial advice tips for 2026. First, max out your Roth IRA, $7,000 or $8,000, to leverage tax-free growth. Second, anchor with 40 to 60% VOO for 12% growth and 0.03% expense ratio. Third, blend growth and income, 20% QQQM or SCHG, 10% SPMO, 10% FDVV, and 5% QQQI for $760 to $1,660 yield on $10,000. Dollar cost average $100 weekly to smooth dips and reinvest dividends to compound tax-free. These ETFs are Roth IRA powerhouses. In 2025, SPMO's 19%, QQQM's 18%, SCHG's 18%, FDVV's 10%, and QQQI's 15%, with dividends, beat VOO's 7.85%. A $10,000 portfolio split 50% VOO, 20% SCHG, 15% SPMO, 10% FDVV, and 5% QQQI grew to $11,800, yielding $760. For 2026, 10 to 15% tech growth and 8% S&P 500 growth could drive 12 to 15% returns, with QQQI's income cushioning volatility. Track strategies on financial community tools in the description. If you love this, smash that like button. Our puppy mascot did. Subscribe for more ETF breakdowns and check out our last video on your screen. Keep crushing the market and take it easy. Peace. This video is for educational and informational purposes only. Investment performance is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult a qualified financial advisor before investing.